Hello, everyone. Let me ask you a question before we begin. When you look at a price chart, what do you actually see? Think about it for a second. Most traders see candles going up and down. They see patterns. They see lines. They see colors. But they are missing the single most important piece of information on the entire chart. And that piece is volume. Let me tell you something that will change forever the way you look at a chart. Price is just the advertisement. Volume is the actual transaction. It is like judging a restaurant only by the sign outside, without ever going in to check if there are any customers inside. A nice sign does not mean good food, and a big candle does not mean a real move. In this video, I am going to show you how to read volume correctly. Not just what volume is, but what volume means, why it matters so much, and how to use it to see what is really happening behind every move in the market. After this video, every candle on your chart is going to tell you a story, and volume will be the proof behind that story. This is not financial advice, this is just education. So let us get into it. Let us start with the basics. Every chart speaks two languages at the same time. Two languages that complement each other. And if you only understand one of them, you are reading half the story. Language number one is price. Price tells you what happened. Did the market go up? Did it go down? Did it move sideways? That is the headline, the news title. It is what you see at first glance. Language number two is volume. Volume tells you how much conviction was behind that move. How many traders participated? How much money actually moved at that point? That is the evidence, the proof behind the headline. Think of it like an election. Price is the result. Who won? But volume is the number of voters who showed up to vote. If only 10 people voted, does that result really mean anything? Can you really trust it? But if 10 million people voted, that is a declaration. That carries weight. That is legitimate. The same thing happens with the market. A big green candle on low volume? Suspicious. Something does not add up. A big green candle on high volume? That is conviction. That is real. That is real money entering the market. So from now on, every time you look at a chart, do not only ask, where did price go? Also ask, how much money stood behind that move? That second question is the one that separates traders who guess from traders who actually read the market. Now, here comes the single most important idea in this entire video. If you only remember one thing from today, let it be this. To read volume correctly, you only need one mental model. Just one. And it is called effort versus result. In the market, effort is volume, how much energy, how much money is being used. And result is the candle, how far price actually moved. Effort and result. Keep these two words in your head for the entire video. Think of it like pushing a car up a hill. Your foot on the gas pedal is the effort. How far the car moves is the result. When you understand the relationship between these two, everything changes. Let us look at 3 cases so this is completely clear. Case number 1, you press the gas. The car moves easily. Big effort. Big result. Everything matches. Everything makes sense. On the chart, that is a big candle with high volume underneath. Lots of buyers, lots of conviction. The move is real. It is like a whole stadium standing up to cheer. That is genuine excitement. When effort and result match, you can trust the move. Case number 2. You slam the gas pedal hard. The engine roars. Fuel is burning. But the car barely moves. There is something blocking the road. On the chart, that is a tiny candle with massive volume underneath. This is called absorption, and it is one of the most important signals you are going to learn. What is happening here? Buyers are pushing with all their strength, but there is an invisible wall. A large seller, Smart money is sitting there, quietly absorbing every single buy order. Think of it like a dam. The water keeps coming and coming, but the dam holds everything back. And when the water runs out, when the buyers exhaust themselves, there is nobody left to push price up. And very often, price drops sharply. Big effort, small result. Be careful. Case number 3. You barely touch the gas, but the car keeps rolling uphill by itself. There is no resistance. The road is empty. On the chart, that is price rising on low volume. This is called no supply. And many people misunderstand it. It does not mean the buyers are super strong. It means the sellers are absent. Nobody is selling. So the market does not need much effort to move. It is like walking on an empty road. Nobody is blocking your path. You move effortlessly because there is no opposition. Now, here is your cheat sheet. I call it the volume matrix. Memorize it. High volume plus big candle. Healthy move. High volume plus small candle. Absorption. A warning sign. Low volume but price still moving. No supply or no demand. The other side is absent. Memorize these 3 combinations. They are the foundation of everything that comes next. If you understand these 3 combinations, you are already ahead of most traders who stare at the chart every single day. Now let us apply the effort versus result model to specific candle patterns. This is called volume spread analysis, or VSA for short. There are 3 patterns that every trader should recognize. Let us go through them one by one. Pattern 1. Stopping volume. Imagine price is crashing. Red candle after red candle. Everyone is panicking and selling. People want to get out at any price. And then you see this. A tall red candle. And the volume bar underneath is huge, the biggest in weeks. But here is the key detail. The candle does not close at the very bottom. It has a long wick below, and the close is near the middle. What happened here? Someone with deep pockets bought everything that the panicking sellers were throwing away. They didn't stop the crash with words. They stopped it with the money. Big effort, small result. The price did not go lower despite the massive volume. That is absorption at the bottom, a potential reversal zone. Pattern 2. Buying climax. Now imagine the opposite. Price has been going up for weeks. The news is great. Everyone is bullish. Retail traders are jumping in because they do not want to miss out. And then you see a huge green candle. The volume is extreme, the highest on the entire chart. To most traders, this looks like massive strength. It looks like price is about to explode higher. But here is the plot twist. This is not strong buying. This is strong selling disguised as buying. Smart money uses that wall of buy orders from retail traders to unload their massive positions. They are selling into the demand, quietly, without crashing the price. It is like a vendor at a night market. The busiest moment. That is exactly when they are clearing out the last of their inventory. And the moment you FOMO in at the top, that might be exactly when smart money is walking out the door. That is why the buying climax is so dangerous for anyone who does not understand volume. Pattern 3. No supply test. After an uptrend, price pulls back a little, and you get worried. You ask yourself, is this a correction? Is the trend over? Then you look at the volume, a small red candle, and volume is very low. The market is asking a question. Does anyone want to sell here? And the low volume answers, no, not really. That is a no supply test. Sellers are absent. The uptrend is likely to continue. It is like testing if a fire is hot. You put your hand near it. It is cool. It is safe to move forward. When the market tests a level and finds no sellers, that is a powerful signal that the trend has more room ahead. 3 patterns. One single mental model. Effort versus result. That is enough to read 80% of what volume is telling you on any chart. You do not need complicated indicators. You do not need 20 different tools. You need to understand effort and result and recognize these 3 patterns. Now, before we go any further, let me clear up the most common mistake in volume reading. And if you have been making this mistake, do not worry. Almost everyone does. I made it too when I started. The myth is this: a green volume bar means buying, and a red volume bar means selling. That is not how it works, not at all. Here is the truth you need to understand. Every single trade requires a buyer and a seller. Always. Without exception. If you bought 100 shares, someone else sold those 100 shares. There cannot be a purchase without a sale on the other side. Volume counts the number of transactions, not which side is winning. And the color of the volume bar. It simply follows the color of the candle. If the candle closed higher than it opened, green bar. If it closed lower, red bar. That is it. It has nothing to do with who is buying or who is selling. Think of it like a crowded fish market at 5 in the morning. The market is packed, high volume. But there are buyers and sellers everywhere. You cannot say today is all buying just because the market is busy. Busy means activity. Nothing more. To know who is winning, you look at where the candle closes. So here is the rule. Do not look at the color of the volume bar. Look at the size of the volume bar, combined with where the candle closes. Size plus close position. That is where the real story is. Forget the color. Focus on the size and the close. Now let us talk about one of the most powerful warning signals in volume analysis. Volume divergence. This signal can save you from many losses. When price and volume agree with each other, the trend is healthy. Is price going up? Is volume going up? Strong. Is price going down? Is volume going down? The selling is weakening. When both move together, everything is in order. But when price and volume do not agree, that is your early warning system. Here is the most important case. Imagine price is making new highs. The chart looks great. Everyone is celebrating. But if you look at the volume bars, they are getting smaller and smaller. Each new high has less volume than the previous one. Think of it like a rocket. At launch, the fuel tank is full. The rocket blasts off with enormous power. But as the fuel burns, the thrust weakens. The rocket slows down. And eventually, it falls. That is exactly what declining volume during an uptrend looks like. The move is running out of fuel. Fewer and fewer traders believe in the move. The same works in reverse. If price is falling, but volume keeps dropping too, the sellers are getting exhausted. Each drop has less and less participation. The selling is drying up. That often signals that a bottom is forming. Volume divergence is your free early warning system. The market has not crashed yet, but it is getting tired. It is like the applause getting quieter after each speech. The audience is losing interest. The show is about to end. When you see price making new highs but volume making lower highs, pay attention. Something is about to change. Now let us turn all of this into a simple process that you can use on any chart, in any market, starting today. I call it the 3-step volume check. Step 1. Zoom out. Before you look at individual candles, zoom out to the daily or weekly chart. Ask yourself, is volume overall increasing or decreasing? Are there any unusual volume spikes recently? Think of it like checking the weather before going outside. You want to know the general climate before you worry about the rain. Always start with the big picture. Step 2. Zoom in to key levels. Find the important support and resistance levels on your chart. Now watch what happens when price approaches those levels. Apply effort versus result. If price touches resistance and volume spikes, but the candle stays small, that is absorption. The wall is holding. Be careful. If price breaks through resistance with a big candle and high volume, that is a real breakout. Effort matches result. But if price breaks resistance on low volume, be suspicious. A breakout without conviction is often a trap, a false breakout designed to catch eager traders. Step 3. Wait for confirmation. This is where most traders go wrong. They see one signal and immediately jump into the trade. Do not do that. After a breakout, wait for the next candle. Does price pull back to the broken level? If it does, and that pullback happens on low volume, that is a no supply test. The market tested the level and found no sellers. That is your confirmation. The patience to wait for one extra candle can save you from 10 losing trades. Let me show you how this looks in practice. Price is approaching resistance. You zoom out. Volume has been steady. Price touches resistance. Volume spikes. But the candle is small with a long upper wick. Big effort, small result. Absorption. The wall is strong. You do not buy. You wait. Price drops. You avoided a trap just like that. 3 steps protected you from a bad decision. 3 steps. Zoom out. Zoom in to key levels. Wait for confirmation. That is your volume playbook. Simple, repeatable, and it works in any market. Before your next trade, run through this quick checklist. Question number 1. Is volume increasing or decreasing compared to recent bars? Question number 2. Does the effort match the result? Big volume should mean big candles. If not, someone is absorbing. Question number 3. Are there any unusual volume spikes near key levels? Question number 4. Is volume diverging from price? New highs on lower volume is a warning. Question number 5. What does the next candle confirm? Never act based on a single candle. When you ask yourself these 5 questions, you are no longer guessing. You are reading the market. You are seeing the proof behind every move. You are trading with evidence, not with hope. Because volume is not just another indicator on your chart. Volume is the truth serum of the market. Price can be manipulated. Price can be pushed around from one side to the other. The big players can paint the chart to fool you. But volume shows you where the real money, the real commitment, is stepping in. Volume is very hard to fake because it represents real money changing hands. So remember this the next time you open a chart. Do not only look at the candles going up and down. Do not be fooled by the pretty colors and the big moves. Always ask yourself, how much conviction was behind this? How much money moved here? Does the effort match the result? That question alone will put you ahead of most people who stare at a chart. If this video helped you finally see what is behind the candles, let me know in the comments. I want to know, which pattern are you going to look for first? Stopping volume, buying climax, or volume divergence? Drop a comment. I read every single one of them. And remember, volume always tells the real story. Price tells you what happened, but volume tells you whether you should believe it. I will see you in the next video. Stay disciplined.